Hey everybody, it's Chuck Barone. Tuesday, October the 17th, 2023. What a wild day today, guys. Some realities setting in here, and we had a wild day in the bond market. Anyway, before I get rolling, let me take a half second. Welcome everybody to the show. And as always, thank you guys for your support, man. You guys keep coming back, keep watching these videos, keep with your comments, and all the, you guys are here. We're going to be here as long as you are. We appreciate it. All right, so let's look at these markets today. It was a crazy day, man. So we got some reports coming in. We knew we were going to get some data today. The big report, of course, coming in is the retail sales report. A huge blowout number. Retail sales jumping 0.7% in September. They were expecting 0.3, so they got more than double. Shows that this economy is still red hot. Well, I don't know about red hot, but certainly hot. Consumers still spending money, man. They have money apparently. They're going into debt. We'll see what that looks like when that report comes out. Consumer credit, but spending still. Consumers in the mood. Not fazed even a little bit by these higher rates as far as their spending goes. So the market's reacting to this data today. The stock market now has to stop and reassess what they're thinking is as far as interest rates go. The belief in the markets was pretty much no more hikes, we're done, and then cuts coming toward the middle of next year. Now they're kind of looking at the data going, okay, well, we can spin things however we like to, but the numbers are there. So now they're thinking maybe another increase this year coming, holding off on rate cuts. They still believe there's going to be cuts next year, but not more toward the end of the year than the middle of the year. So crazy times, man. So the stock market confused, not really knowing, having no direction right now. So the market's certainly turning in a mixed performance today, basically flat. The Dow up 13 points, which is really a non-event. It's sitting at 33,997. The NASDAQ down 34 points, sitting at 13,533. And the S&P just fractional, not even a point up or down, sitting at 43.73. So the stock market today basically taking a breather. Not exactly sure whether they want to be happy because we're getting some amazing blowout earnings reports. All the banks beating their estimates. So that's a good sign for things, the economy. Banks a little bit stronger than they thought they were going to be. At the same time, you got these hot retail numbers. This is going to be inflationary. And Fed's in a tough spot, man. So the bond market today, wow, what a day. Bonds selling off like crazy. The crash in the bond market keeps just rolling along. Rates now sitting at 16-year highs. You got to go back to right after the big kablooey, before they started cutting rates down to zero. You got the 10-year today up 14 basis points to 4.85%. That is just wow. Okay. And the 2-year also up now. So now everybody's jumping. So the 2-year up 12 basis points, sitting at 5.22%. Wow. Those are some of my amazing numbers. Looks like we're going to get a 10-year at 5%, which the markets can kind of, at least some smarter analysts have been predicting for a little bit now. The inversion narrowing a little bit more. Now we're down to 37 basis points. Bond yields creeping up, bond market tanking. It's really amazing too, all the treasuries that are out there right now. Trillions of dollars worth. All getting just pulverized in value as this market continues to crash. Imagine your giant government, sovereign bond holders, and you're holding U.S. treasuries, and you're watching your holdings just get annihilated. It's happening to banks here. It's happening to all the governments around the world that hold U.S. treasuries, which are most of them. So this bond market, crazy stuff, man. Bonds are not supposed to be whipsawing around by these kind of numbers. The bond market in a panic. It's bad. It's bad. The dollar today, surprisingly, sitting flat, basically flat. 4 basis point move, sitting at 106.20. The dollar's still the champ. Higher rates strengthen the dollar. I'm surprised the dollar didn't even rise a little bit today. In spite of this strong dollar, though, gold and silver hanging tough, man. Gold up $2.20 today, $1,921.90 for an ounce of gold. Silver up 22 cents, sitting at $22.82 for an ounce of silver. Fairly valued, I think. Precious metals, I think, have a way to go to the upside as this dollar comes down. But right now, off their highs a little bit, but still packing some decent numbers here in the face of everything they've been dealing with. Inflation is supposed to drive gold and silver higher. So you really would have thought that, over the past year and a half, these numbers would have spiked up a little bit, and they did. We had $2,000 gold, we had $25 silver, just not for very long. But I tell you guys, it's heading back there. Believe it. It's just a matter of how soon. Oil today, up 56 cents. This war going to keep oil high, sadly. The war just keeps escalating, keeps getting worse. Today we're seeing hospitals and schools getting bombed. Terrorism just keeps getting worse, man. Oil, $87.22 for a barrel of West Texas Intermediate. Hopefully we can find a way to end this stuff soon, end these wars, and get back to business and doing the important things, building stuff at home, building stuff up, not blowing stuff apart in other parts of the world. Bitcoin today, down small, down $86, sitting at $28,509. Not much news on Bitcoin. Some bad testimony coming in for our friend Sam Bankman-Fried, who I call Sam Bankman-Fraud, because apparently he was, there's billions of dollars missing from FTX. They're never going to find that money. And when it's all said and done, this guy's going to go away for a long, long time. All right, so let's talk about retail sales. That was the topic of the day today, guys. Wow. Retail sales jumping 0.7% last month, more than doubling expert forecasts of 0.3%. Wow. Wow. So shoppers just keeping on shopping. This is another nail now in this idea that interest rates can start coming down. Puts massive pressure on our friend St. Jerome and the Federal Reserve. And I don't really think that the Fed wants to raise rates again. I think they're afraid that if they keep raising much more, they're going to get a pretty significant recession. But when you see data like this coming across, okay, it's going to force their hand sooner or later, guys. There's going to be more hikes. They're going to try and hold off as long as they can, apparently. I got to say, I'm a little bit unhappy with the Fed because I really thought the Fed would follow the Volcker path. The path that is shown to work, and that would be to keep raising rates until you just squash inflation. You're going to have a recession one way or the other anyway. So why not just bring it on, get it over with, and get rid of this inflation where you have no fear then of setting off a stagflationary period where you got inflation and a crappy economy, which seems to be right where they're heading us. Right? I don't know, guys. I think that, this recession is inevitable, man. It's going to happen. Raising rates will not bring down inflation. It's the slowing of the economy or the recession that will take care of rising prices. And to do that, they need a recession that has a little bit of meaning to it, a little bit of heft. If it's going to be one of these touch and go deals, that's not going to really bring inflation down. So there needs to be some pain. Powell warned us about this. The pain really right now is only basically being reflected in real estate. Everything else in the economy seems to be getting pretty strong. I don't know why the Fed is, I guess because they're, the business collective in this country is so powerful. Because, recessions really are not terrible for rich people like they are for regular working people. And we all know that the rich is the ultimate overlord, puppet masters of our government and their groups, right? So rich people don't hate recessions because poor people tend to sell off assets at discounts, and the rich people tend to buy those assets at discounts. So, I don't know what's so scary to the Fed, but they're getting close to the crossroads, guy. I really thought that the choice would be rescue the economy or fight inflation. But it looks like it's going to be, will the Fed raise rates enough to even cool the economy? Or will they fight, I gotta say, man, I've been looking at these markets for 100 years, it feels like. I usually feel like I know what's going to happen, what's coming. But this is just some craziness. Crazy, 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 crazy. I was reading today, this recession tends to come roughly 12 months after peak rates. So we've got a ways to go before we get to this recession yet, guys, okay? The economy is still chugging along pretty nicely. There's lots of jobs. Consumers are now, I don't know whether they're good or bad jobs, but there's jobs. Consumers borrowing and spending like it's going out of style, like they got to spend every last dollar. This spells it out for the Fed, man. Rates are not high enough to discourage people from borrowing money and spending. It's just that simple. You don't have to go through anything super complex. So tough choices ahead for the Fed. Do they really finish off real estate for good? Or not for good, but do they really just crash real estate down and banks by raising rates again? To slow this economy down? I don't know, man. The Fed seems to be a little bit of a chicken. I thought we would get raised I thought the end of the month we would have our rate increase. We didn't get it. Goldman Sachs today coming out, so they expect third quarter GDP to come in at plus 4%. Pretty hot number for the economy. Manufacturing production, we also got that report today, up 0.4% last month. So manufacturing looking pretty good. Real estate and mortgage, however, yikes. Not so good, guys. Home builder sentiment tanks, lowest it's been in a year. And this is home builders, the guys who are getting the good part of the market right now, the guys that all of the people who want to buy houses are flocking to. They're not happy. American households, I read this article, blew my mind. American households now need an income of $115,000 per year to afford a typical house. Guess what? The average household income in the United States is about $74,000. So we got quite a gap, 40 grand gap between the average and affordability for a house. Not good. Mortgages continuing to climb higher, continuing to go higher. I think we could see 8% mortgages any minute, guys. And that will finally put the nail. I might as well just chill for a year because that's going to really sink it for real estate and mortgage. Anyway, that's it for the day, guys. I appreciate your support as always, man. You guys mean the world to us. If you got a second, please hit the like button. It changes the algorithms around, gets our video out in front of a few more viewers. As always, hit me up, comments, questions. We'll be back tomorrow with more data. Stock market going to have to figure it out one way or the other pretty soon. Anyway, until then, until tomorrow, guys, take care. Thanks.